Our next guest calls it a moment of dual fragility for equities, but believes the recent dip will likely be bought. And that's certainly playing out today, although off the morning lows. Fundstrat's head of research and CNBC contributor Tom Lee joins us. Tom, you've been good about taking things like, say, a job print or CPI and arguing that it's an opportunity if there is a dip. Is it a harder call when it does involve geopolitics?
It's definitely a harder call because the scope of the path this escalation can take place is unknown. But at the same time, we can look at sort of past episodes and past war instances or conflicts and understand how markets react and where positioning is. And I think that's what's giving us some confidence today that there's a lot less leverage now. And I think the Fed's in a very different position where the Fed could be supportive. And that's why I think, as uncertain as it feels right now, I think this dip will be bought.
Does it create downside risk for your year-end target, let's say?
I think when you move beyond the 1 month, even 3 months, or even 6 month timeframes, I don't think that these actually affect the trajectory because, the drivers of our year-end target are this recovery in corporate profits, the upturn in business confidence measured by ISM, the fact that consumer leverage is still quite low, and that monetary policy is actually supportive of the business cycle. So I think these things all are still at play between now and year end. And, I think our 5,200 target is too low, but I think it's still too early for us to raise our target as well.
Yeah, I mean, I read your note over the weekend. I cited it. A lot of it does rest on this idea that the Fed is in a very different mode. And as you referenced, they're sort of in easing mode. But the story, Tom, has been that they are not going to be able to ease so easily or so quickly. And today's retail sales data only adds fuel to that fire. So I do wonder how much of your thesis depends on the Fed cutting this year.
Sarah, I think it's important for the Fed to be dovish this year. And in terms of how many cuts they do, I know there's going to be a lot of debate about, well, is it 3 cuts or is it 2 or 1? But it's really going to be the reasons why they make fewer cuts. If the economy is resilient and inflation is not accelerating, so they end up doing even as little as 0 cuts, that's actually quite bullish because, one, the Fed still has a lot of firepower to make future cuts, and it just shows you the economy is handling higher rates pretty well. I mean, I think it would speak really well for equities if the Fed made fewer cuts, but for the right reasons.
To the extent, sorry, your thesis depends on obviously earnings coming through. We're at the beginning of earnings season. What are you looking for both now and through the back half of next year in terms of S&P earnings and growth rate?
Well, earnings in the fourth quarter that was reported 3 months ago came in close to 8% above expectations. That's already flowed through into what we expect for 2025. First quarter's already looking pretty good. More than 80% are beating. So I think our 2025 earnings, which is officially 260, and that was 8% earnings growth, is probably low. It's looking like it's going to end up being closer to 270, maybe 275. That's a $15 higher earnings for next year just because of the strength of earnings we're seeing now. So I think profits are coming in pretty well. I mean, inflation's cooling, but companies are still finding operating leverage.
How did you see the action that we saw in the tech sector last week? How do you see investors, or how do you believe that investors should play it going forward?
I think it's nervousness just given the overall market, geopolitical, and everything going on with the 10-year. But look, I think it's a get out the popcorn moment. I think this is going to be a robust tech earnings season next few weeks. We view this more of a golden buying opportunity, given what we see in cybersecurity, the AI revolution, and digital marketing and advertising that's trending ahead of expectations. And that's our view. This is not the time to run. It's actually the time to own the winners.
All right. So Dan Ives is bullish right now on tech, saying this is a buying opportunity. Steph, how do you see all this? I mean, we got earnings season coming up. We're seeing earnings expectations continue to fall. Right now, how do you view the action that we saw in the market last week? As someone who obviously advises clients, how are you advising people to play the markets this week?
I think it's pretty remarkable, Frank, that we're only down 2.5% from all-time highs in the S&P 500. And in the past 16 months, we're up 33%. We've had to deal with hotter inflation, an unknown Fed, bank earnings on Friday, which weren't great, but I don't think, by the way, they were as bad as they reacted. But nevertheless, it wasn't good. We have the geopolitical issues. I think the reason we're bouncing back today is because Israel was actually pretty successful in terms of shooting down 99% of the missiles and drones that came at them. We don't know what their game plan is, and I think that's the reason we're going to stay volatile. But I want to step back for half a second and say, why exactly is inflation hotter than expected? Inflation is hotter than expected because we've had an unprecedented amount of fiscal stimulus in the system for the past 4 years, and that is acting as a nice tailwind for the economy. We're growing above trend, and that will lead to better than expected earnings. And I agree that with Dan that technology earnings will be good. But the thing is, other sectors' earnings will be good, and some of those sectors have really, fallen by the wayside. And I think there's your opportunity.
All right, so you're saying earnings are going to be good, Steph, but I mean, I'm looking at communication services. The estimate is for it to be basically 29% higher year over year. Basically, tech 21% higher year over year. Do you think it can live up to those lofty expectations, even as we more broadly see earnings expectations decline?
I think you're going to see 8 to 10% growth in the S&P 500. I think technology will actually deliver, but they are over-owned and there are higher expectations than something like energy, which should see growth in earnings. We should see industrials do very well, 15 to 20% organic growth, free cash flow. And I think you're also going to see good numbers in the materials and in some of the discretionary. I'm most excited this week, actually, for D.R. Horton to report, because I think housing is on the mend, and I think that's a place where you want to be investing as well.
All right, Dan, I'm going to come over to you. Obviously, again, earnings season's kicking off. You're looking at the cybersecurity sector for opportunities, but it's kind of a head scratcher. Ever since Palo Alto Networks reported back in February, the entire cyber sector has taken a pretty steep decline. Do you believe that's going to see a turnaround during earnings season? I mean, why would you want to buy cybersecurity stocks right now when they've been under so much pressure?
Yeah, look, I think this is the massive disconnect. I think this is going to be a turnaround for the ages. For cybersecurity, Zscaler, CrowdStrike, we're actually strong buyers of Palo Alto here in terms of the transformation they're making. And right now, I think this is going to be one of the biggest subsectors of tech, especially as you have all.
But what are you seeing that the market's not seeing, Dan?
Because everyone's taking what happened with Palo as ultimately just the start of a shot across the bow negative. We see the opposite, which is why right now, Frank, this is a pound the table time on cybersecurity, in our opinion, and that's how we're hand-holding investors through it.
All right, so you're hand-holding investors through it. Steph, I want to come back to you. Something you've been looking at is the money and money market funds. Right now, according to ICI, there's about $6 trillion in there, but in April, about $31 billion came out of those money market funds. How do you see that impacting tech investing, but just the markets overall?
You know what's interesting, Frank, is Larry Fink of BlackRock on Friday said that there was $9 trillion in money market numbers. So he must have the most updated figures, because I actually also thought it was about $6 trillion. Well, it doesn't even matter, 6 or 9. There's a heck of a lot of money on the sidelines. That, okay, I get it. It's getting 4 or 5% in interest, so you can sleep well at night. But you're going to get much more in terms of total returns in the S&P 500. And that's actually also what Schwab, their management team, has said. They look at cash balances on a month-to-month basis, and those numbers have been coming out of money markets and cash on the sidelines going into the S&P 500 because there's this fear of missing out. And if I'm right, and we have better than expected earnings, and we have a broadening out in earnings, that's all the more reason why you do want to be buying on these dips.
All right, Dan, I'm going to give you last word. I know you're bullish on cybersecurity. Give us your other top picks for right now.
Yeah, so overall, look, we be Microsoft, to me, from a cloud perspective, these are going to be jaw-dropper numbers in terms of what we see there. Google's another one. Some of the parts, AI could add $30 to $40 per share. And then overall, when you look at the AI revolution, it's Palantir, front and center, in terms of the use cases. This is just the start of a 1995 moment. I think tech, leg higher, we see 15% up the rest of the year.
Yeah, in your notes, I also see that you like Salesforce. Quick take on that Informatica report that they're possibly looking to acquire Informatica?
Oh, we would loudly applaud that. That would be a no-brainer. I think Benioff right now is on the offensive, and I think this is exactly what you want to see from the tactician gaining more and more share, this would be an acquisition I think the street would cheer.
Well, joining us now, Mohamed El-Erian is Chief Economic Advisor at Allianz and President of Queens College at Cambridge University. It's great to have you here, Mohamed.
Wonderful to be here. Thanks for having me.
We see the markets sort of unclenching a little bit. I mean, obviously, part of Friday's decline seemed to be anticipation of what might happen in terms of this anticipated attack that did come to fruition. But then, of course, doesn't seem to necessarily be carrying through to animate today's market action. So what are we left with? Bond yields going back toward their highs of last week. We're repricing what the Fed might do. We've had to digest these hotter than expected inflation numbers. What's the thing you're most focused on?
So first, I think it's fascinating that the market has concluded a fact and a hypothesis. The fact is that the damage over the weekend was contained. The hypothesis is that there will be no further escalation. That is very different from what the national security people are telling you and us in terms of we've crossed a new line, it's the new Middle East. So I think the market is willing to put that aside and be comforted by three things. One is that we will continue to see productivity enhancing innovations advance. Two is that the Fed at the end of the day will be accommodating to markets. And three is that soft landing is the most likely baseline. And it's a good thing for the marketplace in the short term to have those three things, but we should listen to the national security people because I do think things have changed in the Middle East.
You mentioned those three things. They certainly are underlying the premise of where the markets have gotten to this year. Now, of course, I'm looking at the S&P 500. It's only picking up a third of what was lost on Friday. We are still a few percent below our highs. It seems as if the outlook has become a little bit less clean, at least, even from a macro perspective, given the way people are wondering if the Fed is going to kind of get itself into a corner here and not get through the easing that it wants to.
So we've been pricing in something that we've discussed for a while and that I have felt for a while, is that inflation is going to prove sticky, that the last mile is really complicated, and that we're not sure what the Fed's reaction function is. If the Fed remains data dependent, then the Fed will be more hawkish than it needs to be and that the market expects it to be. If, however, the Fed looks forward and, to use Steve Leisman's phrase, embraces more of an inflation framework and model, then it will deliver on the two cuts this year. So the marketplace is having to price in this reality that inflation is sticky.
But I'm still unclear where you are.
So I am hoping that the Fed will be less data dependent. I am hoping that they will look forward, realize that the economy is weakening, and deliver on two cuts starting as early as July. That is what I'm hoping.
But then if the Fed does do those two cuts and inflation has been stickier and does come back with a vengeance, wouldn't that be wouldn't people blame the Fed for acting too prematurely? Is that in their minds at all?
So the key issue you've said, come back with a vengeance. So my macro model, my macro paradigm is we are living in a world of insufficiently flexible supply side, very different from the world we lived in after the global financial crisis where there was enough demand. That insufficiently flexible supply calls for a slightly higher inflation target. The Fed cannot declare a higher inflation target because it missed so long and by so much. So what we're going to do is we're going to see this phrase longer term come in before they talk about the inflation target, and we will settle at an inflation at around 3%. And I suspect it is stable. I suspect it doesn't de-anchor inflation expectation. So the other bit of your thing, that inflation comes roaring back a la 70s, that doesn't happen.
Well, I mean, it is worth reminding folks that, first of all, PCE inflation is their target. It's under 3. It's probably going to stay under 3. They only think it should get to 2.6 by the end of the year, from 2.8, let's say, in order for them to get those cuts in. The other thing is, through the span of history, inflation plus or minus 2.5%, 3% is not necessarily a big impediment, right, to the economy or to the markets.
That's absolutely right. And I would add to that 2% is a totally arbitrary target.
Right.
We only have 2% because back in 1991, the Bank of New Zealand adopted 2%, right? That's why we have 2%.
The tensions in the Middle East have hit a new high as Israel considers retaliation against Iran after that missile and drone attack over the weekend. For a closer look at all of this, I want to welcome my friend David Sanger, New York Times White House and national security correspondent, one of the great veteran experts of this space. His new book is out. It is called New Cold Wars, China's Rise, Russia's Invasion, and America's Struggle to Defend the West. And in truth, I want to get into the China and Russia of it all because it relates to this entire story. But I want to get just right at this weekend and where we are in this particular moment. I know it's impossible to handicap, but we were talking about, do we think this escalates? Do we think it doesn't? Where do we go from here? What is your expectation?
So it's a really fraught moment, a really hard one. It was really interesting to see President Biden on the phone to Bibi Netanyahu hours after this was over saying, take the win. You know, you shot down all this stuff. You started this in some ways by doing the strike in Damascus, which the Americans were very upset about and didn't think the Israelis should go do for fear of exactly this. The whole effort by Biden so far has been avoid escalation here. And I suspect that at least for a while, we're going to see a calm. But there is a Rubicon that's been crossed here. In the 45 years since the Iranian Revolution, Iran has never attacked Israel directly from its soil. And I think the taboo on the Israelis attacking back is now lifted.
Okay, but let me ask you, Biden may be trying to put pressure on Netanyahu, but that hasn't, especially in recent weeks.
He doesn't have a great track record.
So that's the question. What do you, I mean, to the extent that you've been doing reporting over the weekend on this, what is your sense of where Netanyahu is, where the Israeli people are, what this government around Netanyahu is telling him?
So he is obviously desperate to stay in power, and I think the longer that the crisis goes on generally helps him. But I think he also recognizes that if he goes back too hard on Iran right now and this turns into a general conflagration, he's going to lose his objectives in Gaza and he's going to lose the other. So, you know, he's probably going to stay focused on Gaza. He's got to do something in response to this.
Right.
The question is, can they calibrate it? And do the Iranians catch the calibration? Because the biggest mistake that happens out here is someone reads wrong how the other guy's going to react.
Okay, let me ask you about a different read, if you will, which is, and it goes to this book, New Cold Wars, which is the Russia and China of it all, and their relationship both together and, frankly, potentially as a supporter of Iran.
Yep.
And how that relates to whatever pressure points we have or leverage we have or, frankly, don't have with either of those countries.
So, Andrew, this is the big change from even 9 or 10 years ago. You'll remember those 2015 negotiations to stop Iran's nuclear program.
Right.
Russia and China were part of the negotiations. They were sitting on the American side of the table, right? This time, they are part of what the Iranians call the axis of resistance to the West. Obviously, Iran is providing drones to Russia. They may be on their way to providing missiles to them. The Russians are not going to be part of the effort here to bring this down. Also, China and Russia are perfectly happy to see the U.S. wrapped into the Middle East again, as you were saying.
Tesla shares are down again, as you see, down some 33% for the year. This following news, the company is going to be making some sizable job cuts. Phil LeBeau has that news for us. Phil.
David, these are significant cuts that Tesla is announcing. A memo sent out by Elon Musk to the staff outlining that the company will be cutting more than 10% of its global staff. They ended last year with about 140,000 employees worldwide, so approximately 14,000 workers will be let go. In the memo that was sent out from Elon Musk, he says, "There is nothing I hate more, but it must be done. This will enable us to be lean, innovative, and hungry for the next growth phase cycle." As you take a look at their annual deliveries, remember, the first quarter, that was the first time that we saw Tesla deliver a year-over-year decline in 3 years, and it was down 8.5%. Many believe that there is a possibility they will not hit last year's total of 1.81 million vehicles delivered. So as you take a look at shares of Tesla over the last 6 months, the next data point that people will be focused on happens on April 23rd. After the bell, that's when the company reports its Q1 results. And the focus there is going to be automotive gross margins as well as the operating margin. Both have come down significantly over the last year. And commentary from Elon Musk. Is this the first of many job cuts that we're going to see? Or is this a case where Elon's moving as quickly as possible to say, look, we have to downsize, we have to shore up as much as possible as we go through this period here where deliveries will be down, where there is just a tighter market overall for EVs, and where the pricing war shows no sign of ending, especially over in China.